So jumping right in, it was a tough quarter for the portfolio. Without oil and gas, where the energy companies within the TSX small cap were ahead by an impressive 45% on the quarter, and taking the weighting for that index through 20%, we were challenged. We were further challenged by a market that preferred value over growth. I know Amber in particular follows the S&P 500 growth versus 500 for value. And you'll find that the S&P 500 growth was down by 7%, whereas the S&P value was ahead by 0.7%. So, when you look at the construct of our portfolio, we were disadvantaged into this marketplace. Fortunately, our longer term numbers provide compelling support for our catalyst-rich, growth-focused top pick portfolio model construct. I would also turn your attention to Echelon, returning a very impressive 12.8%. Amber will dive into it. He remains very solid behind Echelon as a larger cap, very disciplined operator with a healthy balance of organic and inorganic growth that is not fully factored into the marketplace in Amber's view. We were also pleased to see E3, a new name to the portfolio in this quarter, advanced by 3.9%. So encouraged in that front. When we look to our exposure in the cannabis space, Andrew remains a star contributor for his longer term performance, along with his consistent relative outperformance. But his space has hit headwinds. Those are headwinds not just associated with Andrew's space, but also with the telehealth and the healthcare names more broadly. While recognizing the market, we are avoiding any temptation or pull to change our mandate or style shift. We are sticking with our concept, our construct, our longer term outperformance. That said, we don't have our heads in the sand. So it's probably not a coincidence that the two new names added to the portfolio for this quarter both have strong financials, strong margins, and financial flexibility. Those being Flagship and in Playmaker Capital. Now, jumping over to the telehealth, technology, gaming, gambling under my coverage, along with Mike and Andre, we are sticking with CloudMD. We are very bullish on their employee health services in particular. We believe they have a unique value proposition addressing a large and growing North American marketplace. Their EHS service, it starts with a unique navigator point of contact that directs covered employees, to the appropriate care provider on an expedited basis. We happen to use CloudMD, and we have their navigator functionality. So if any on the call are looking for healthcare, you may have experienced the advantages of the personalized navigation. It results in an employee win where you are getting better, quicker, appropriate care and an expedited return to work. And it's that expedited return to work and return to work in a better mental or physical position that in turn helps the employer and provides a very easy payback, positive payback to the employer. We've done it before, but we wanted to walk through the marquee win that they experienced with Sun Life, and it's a great example of what they have in the marketplace. Quickly, Sun Life has 3 million benefactors. If you say 1 million of their benefactors is migrated onto the navigator functionality, That means that CloudMD will be paid roughly $2 per covered employee per month. That would be a $24 million revenue run rate with 1 out of 3 going from Sun Life. It would have a 40% margin associated with that. But that's not all. The second win for CloudMD and the employee is where they direct you to someone with internal capabilities. As an example, if they were to direct you for a mental health claim to a MindBeacon service provider, MindBeacon would essentially have a paid user acquisition. Rather than putting money out to acquire a patient, they would be paid by virtue of the monies being received for the navigator function. They would also be getting a client who would not churn, as is the case all too often where MindBeacon is reaching out as a single service component to the marketplace. So that's where a MindBeacon within CloudMD has a lower churn, a lower COA, and a much extended reach. With respect to CloudMD, it's also important that this is a company that under-promises, over-delivers. With respect to the MindBeacon, initially synergies were 2 million, then 4 million, now 7.5, and we suspect that there is upside. Now we need to address the announcement this week with respect to Essam, the CEO, founder, stepping down as CEO to become a board member and strategic advisor to the company. With respect to Essam, he recognized that it is becoming a larger company with 800 employees. He feels he adds more value and has a better skill set associated with strategic input and building. He believes he will have more time as a builder rather than a manager of 800 people. With respect to Karen, we have every confidence in her capabilities. And we would note that it was Karen Adams who developed the strategy of pursuing EHS, employee health services. They put together the picture, they identified the targets to fulfill the needs that they needed and acquired them on a curated basis. These were relationships that Karen brought to the table, decades-old relationships. So Karen is recognized internally as the driver, the architect behind those EHS services. So the transition from Essam to Karen would not be seen as an issue. We would also note that for CloudMD, they have 55 million of cash. We have confidence they will turn EBITDA positive in the third quarter. We will note one example where a peer, Oak Street Health, announced a scale back on expenditures to focus on profitability, and that stock was up by 30%. So it's unfortunate that the CloudMD shares are down. We would point people to the correlation between CloudMD and Teladoc in the US, where they track very closely, too closely, despite, in our opinion, CloudMD having a much better business profile. I will jump into a longstanding constituent, Converge. The company is 30 deals in, and our mantra of copy, paste, accrete, repeat remains. It's reinforced. The typical deal here is $100 million to acquire a hardware reseller. They pay 5 times at 3 million EBITDA for that company, paying 15 million. They can take that to 6.5 million very quickly. So they're paying 15 million for 6.5 million of EBITDA. They're probably paying 10 million upfront. They're probably recouping 8 million of working capital from that entity by extending their payables from 8 days to 75 days. It's a very solid name for us. It has been beset by headwinds associated by supply chain, but we believe that if you look at the revenues plus bookings, they outperformed in Q3, Q4, and Q1. So we may remain very firm on that name. Moving to Quisitive, once again, a returning name. For us, this one is a really simple pitch. Buy it at a discount to its IT services, and then you see which, the IT services we have valued at $1.26 per share, whereas the stock is currently around 90 cents. So attractive against those assets alone. And then you have significant upside associated with their independent sales organizations, ISOs, that deal with merchant billing and processing payment, and their newly certified LedgerPay payment platform, where they received MasterCard approval just over 2 weeks ago. These two aspects represent the support behind our 275 price target. We think that the company at some point will have to address the question of, your LedgerPay is worth nothing in the marketplace. It's worth $300 million to Microsoft. I think their answer should be selling a minority stake to Microsoft. We're going to jump here to Playmaker. It's a new introduction to our coverage. It's a new introduction to the portfolio. It is a high growth company supporting 35% margins. It's a case of tier one management putting together a series of 11 curated acquisitions over the span of a year, where they went out to relationships, bought founders who were looking to partner and accelerate their growth. It is one wherein the pro forma LTM organic growth would be 90% plus. They have a huge strength serving the Latin speaking markets. And if you were to take the US population that would identify with Latin speaking, look at their GDP, that represents, I think it's number 8 against global countries. So it is a significant marketplace. We look for gambling to be a huge positive catalyst, in that legalized sports gambling drives users, drives user sessions. It brings betting related advertising, and it is a very effective lead generator for betting platforms, where they will pay dollars upfront for the person on the sports platform who links through and places a bet. We see this year as being a very strong year with World Cup in the fourth quarter. That will be their showcase. Very confident our numbers are baseline, very confident in accretive acquisitions. It's a really attractive name for us, where on valuation, we have it trading at 7.9 times 2023 operating cash flow, or EBITDA. If you were to put together an equivalent company across its peers, it would be trading at 14.5. So we see upside to numbers, accretive acquisitions, and positive revaluation considerations. Sort of a nice trifecta before factoring in catalysts. And with that, Emmer.
Great, thanks, Rob. Hi, everybody. So we're sticking to our guns with Ready, Shred, and Callion. And there, if you look at my research universe, you'll notice these aren't necessarily my highest sort of returning target price names, but the way I go about picking my top picks are like, what is my downside risk here, and how does that compare to upside? So we'll attack Ready Shred first, tickers KUT. They've had a fantastic 2021, up 30% since we nominated it into the top picks portfolio. We think 2022 might be actually better. And I do think that a lot of you have heard me speak to the company before. Rob, if we could go to the next slide, please.
Okay.
Yeah, here you go. Thanks. For those of you who don't know the stock, as the name implies, Ready Shreds, it's a shredding business. They do paper shredding. You often see that in offices, but they'll also do electronic shredding, i.e., they're going to come take all of our laptops, servers, and shred it into 1,000 pieces. And they've got a scanning business as well, i.e., they're going to digitize all this paperwork before they shred it, if you'd like them to. Where I'm sort of scratching my head, so this stock is like trading 20 or 30% below its pre-COVID levels. Yet since COVID, they've doubled their revenues, went from $20 million to $40 million, and they've tripled their EBITDA. Pre-COVID, they're at $5 million run rate EBITDA. Today, we're running at close to $50 million. So not only is it cheaper, but the P&L looks much stronger. In terms of valuation, it trades below 7 times EBITDA. If you look at the next 12-month EBITDA, it says 7.5. And that's because there isn't full contribution of the acquisitions they've made, whether it's slightly below 7 or 7.5. The larger peers trade at double that. They trade at 15 times EBITDA. Then if you compare the operational metrics, Ready Shred's growing their sales at a 15% CAGR, while peers are growing at 3 or 4%. So we feel it's a total disconnect because it's micro-cap plans. Micro-cap doesn't necessarily mean that it's higher risk. This is a profitable operation. It's high recurring revenues. We think it's a slam dunk. The next one, Calian. So yeah, as Rob mentioned in his intro, that stock has been one of the top performers in small cap tech and industrial space. Let's call it a larger cap, small cap company. Up 13% for the quarter. It's nice after being flat for 2021. For those of you who don't know the company, the quick and dirty here is it's a company that essentially went from a steady Eddie dividend paying operation to a company seeking out growth in a much more aggressive manner. And that sort of sparked the stock outperformance over the past like 3 or 4 years, if you look at the charts. And I'll tell you where we are different than peers. We argue that this is an acquisition-driven story, and valuing the company on short-term earnings or EBITDA does not really do it justice because it fails to recognize the value of deploying capital into M&A, and this management team happens to be very great at it. In terms of what the company does, it's a hodgepodge of verticals, but it's like extremely diversified. I'll tell you the 3 largest segments are number 1, satellite ground systems. These are the central nervous systems of satellites in space. They sort of control everything that's happening. And when you think about all the satellite launches we have over the next couple of decades, the guys at Calian are extremely busy. The second largest segment is health, which is pretty diverse as well. Historically, it was a staffing operation to provide healthcare services to the Department of National Defense. And they're diversifying there into higher margin businesses. And the third sort of largest business, it's getting close to the same size as advanced tech and health, is IT services. And Rob spoke to IT services a little bit. It's implementation of ERP systems that Calian are doing for government funds. In terms of valuation, the company trades at 10 times EBITDA. I feel this EBITDA is sort of understated because, like this company does acquire, and these EBITDA numbers do not include these acquisitions. And the comparables are trading at 13-ish times. So it's a boring company, but boring is good. Very profitable, generates good free cash flow, and still pays a dividend. With that, I'll pass it on to my colleague, Andrew. Over to you.
Thank you, Amer. Hope that's coming through okay. Perfect. Just before I go here into air wellness, just a brief comment on the cannabis sector. As Rob mentioned earlier, It was another tough quarter for performance. Over the past year, we've seen 90% correlation amongst names, and pretty substantial declines. However, this does come after a very strong year for our coverage names in 2020 and the early part of 2021. For this quarter, we have extended our relative outperformance relative to cannabis industry benchmarks, most notably, and our preferred benchmark, the New Cannabis Ventures Global Cannabis Stock Index, which was down 14% for the quarter, whereas the average for our cannabis top picks was down 10.2% for the quarter. So a modest outperformance there. In a difficult environment, we believe investors are continuing to favor companies that are fully funded and have clear pathways to positive free cash flow, specifically in the back half of this year. Turning to our two top picks for this quarter, we are returning Ayr Wellness and Verano Holdings, and we will start with Ayr. Ayr, we continue to view as the most compelling valuation in US cannabis. It trades at a multiple of just 8.6 times our 2022 EBITDA estimates and just 4.1 times our 2023 EBITDA estimates. That 4.1 times multiple is the lowest multiple in our comp table for large cap US cannabis companies, with the average there being 6.6. So the company does trade at an unreasonably large discount, which offers potential for healthy returns, we view, within the next 12 months, and more specifically in the second quarter. In addition, the company continues to do well operationally. However, despite the strong operational progress we feel it's made, there was a growing consensus that the company would have to revisit its 2022 sales guidance. It did that within the first quarter. That Band-Aid has been ripped off. We now see better opportunity for Ayr to surprise to the upside after consensus expectations have been reset lower. We would note the company trades at the attractive valuation multiples I mentioned after this consensus reset has happened. In terms of the catalysts we're looking for in the second quarter, we believe we finally will see Ayr get the regulatory approvals needed to move forward with some substantial transformative adult use sales beginning at its stores. More specifically, we believe adult use sales begins in New Jersey this quarter. Several operators are ready to go in that market. We believe Ayr is one of them, and we believe they will be amongst the first approved stores to be allowed adult use sales. In addition, Ayr will open its first Massachusetts adult use stores within the second quarter, in our view, subject to regulatory approval. But Massachusetts store openings have generally been viewed positively by investors in prior situations we've seen. Also for the year, we're looking for it to close its remaining acquisitions. And finally, we're looking for progress and facility updates that we believe give greater confidence, both those items giving greater confidence in its growth ramp and its financial outlook for the year ahead. Our target price of $70 would imply upside of 320%, roughly 320% from the company's recent share price. So very healthy implied upside. And we are the street high price target on this name. And we think Ayr can deliver. Next slide. Turning now to Verano Holdings. Verano is a very high quality operator within the US cannabis business. It is well regarded within the industry and by investors. Recently in New York, and most of the accounts I spoke to there, this was their largest holding. We do believe Verano is firing on all cylinders. It has built a very strong portfolio of high-performing assets in attractive limited license markets. It has been very active with M&A, where it's deployed over $900 million at a weighted average multiple of 6.9 times our 2022 EBITDA estimate. So very savvy capital allocators and with an aggressive growth strategy. Like Air, we believe adult use sales beginning in New Jersey will be a catalyst for this company in Q2. Verano is another of the businesses that has some of the most supply ready today. And so it should be able to service the adult use market once sales begin. And again, we believe that happens in the second quarter. We are also looking for several of Verano's other state markets, such as Pennsylvania, such as Ohio, and such as Maryland, to push forward with adult use approvals within the second quarter. I would note that just earlier this week, Maryland announced that it will put an adult use question before voters on the 2022 ballot to happen in November. So we are seeing that legislative process at the state level that we were hoping to see, adding new and sizable adult use market opportunities for Verano in the upcoming quarters and years ahead. And then finally, on the valuation, Verano trades at 7.1 times their 2022 EBITDA estimates. This would be a discount to the peer group average at 11.2. And it would also be a larger discount to Verano's three closest peers, Green Thumb Industries, Cresco Labs, and Cureleaf, which trade at an average multiple of 12.4. So again, an unwarranted discount there, given its strong operating cash flows, given its solid operations, and given its sound M&A strategy. And with that, I will leave that there and turn the call over to Stefan. Stefan, over to you.
Thank you, Andrew. And I want to thank the team for not making me go last, given the poor performance of my picks last quarter. In my defense, I want to highlight that the small cap healthcare space has been a bit of a very challenging sector over the last quarter, both in Canada and the US. So both the names I picked were down, but they were down pretty much consistent with what we saw both in Canada and in the US. For example, the US biotech spider was down over 20% in the quarter. So a very rough quarter for healthcare. But for those of you who like the sector, I've seen some very, very attractive valuations across the board. But with that, I want to say that I'm sticking with the same two names, given that they've only become more attractively valued in the sell-off. So the names are Quipt Home Medical and Diagnose. I'll start with Quipt, 11.25 target price, which represents about 100% upside from where the stock's trading. For those of you who don't know the company, they're a US-based distributor of durable medical equipment for home care of patients with respiratory problems. So think of things like ventilators for people with breathing problems or CPAP instruments for people with sleep apnea. We like the business because of three major drivers. The first is strong demographic tailwinds from the aging population that has consistently drove organic growth in the sector mid to high single digits. The second is we think the company's in an M&A sweet spot due to its industry structure, which is highly fragmented and allows it to benefit from accretive M&A opportunities, typically paying under about 5 times EBITDA for acquisitions prior to synergies, which takes the multiple down probably another turn or more, depending on the acquisition. And then finally, there's an ongoing shift to home care, which is undeniable. It was accelerated by COVID, of course, but we think it's going to last well beyond the pandemic. First, because patients prefer it, but more importantly, it provides cost savings to payers like Medicare because it is cheaper to care for someone at home than in a hospital or nursing care center. The key catalysts for the stock are potentially creative M&A transactions that could lead us to increase our estimates. We're confident in the company's growth trajectory, which is about 40% in fiscal 2022, since the company announced a spate of M&A transactions late last year, which basically assures that this level of growth is largely baked into the company. And it's also consistent with the company's guidance to exit calendar 2022 with a revenue run rate of about 185 million US in revenue and about 41 million US in EBITDA. Finally, in terms of valuation, we think the company is very compellingly valued, particularly given its growth and potential for accretive M&A. It trades at about 6 times forward EV/EBITDA versus its peers, which trade around 9 times. So moving to Diagnose, which we have $1.55 target price. Diagnose is an artificial intelligence company with a platform to diagnose diabetic retinopathy. Diabetic retinopathy is the leading cause of blindness in adults, and it occurs when unhealthy blood sugar levels in diabetics cause blood vessels to grow on the retina on the back of the eye, which leads to vision loss. The process is completely asymptomatic. You don't feel it happening. And the only way to identify the problem is by taking a picture of the back of the eye with a special camera that's used by eye doctors and grading the severity of the diabetic retinopathy. Diagnose has developed an AI system that does it extremely well and efficiently. Their model is highly scalable, is a highly scalable software as a service approach where they charge about $5 to $10 per diagnosis. So this is a win-win for eye clinics that charge about $30 to $50 for this type of test, since it allows them to see more patients and allows the doctors to be more efficient and focus on more valuable procedures. There are about 450 million diabetics in the world, and they're all supposed to have a retinal exam once a year, given the risk for diabetic retinopathy. So this is, very big market opportunity in the multi-billion-dollar range. The company has a number of partners using and piloting their technology. It was hit pretty badly by COVID, which impacted operations of eye clinics and optical retailers. Their biggest client is New Look, which is Canada's largest optical retailer with about 400 stores. They signed them on last summer, and they are in the process of installing the software in the stores. While this is going a bit more slowly than we had hoped, revenues are growing sequentially quarter over quarter, and the company expects to be cash flow positive by mid-year. The company's also been very active on the business development front and is working on winning some meaningful contracts, which we expect to occur over the coming quarters. Indeed, the biggest opportunity is with Echelon, which is by far the biggest player in the eye care space, with over 15,000 retail locations. Last year, Diagnosed announced a memorandum of understanding with Echelon, and the hope is that they can finally conclude a deal in the coming months. This has been slow in coming, but I've been speaking with the company, and they're continuing to work on trying to get this deal closed. We think this would be an absolute game changer for Diagnose and a strong catalyst for the stock. So with that, I'll hand it off to David Crystal, whose picks last quarter made me look particularly bad. So with that, take it away, David.
Sorry about that, Stefan. Wasn't intentional. Thanks, thanks, and thanks to everyone on the line. Just before we get into the top picks, I just want to touch base really quickly on the real estate space, which, despite the performance of one of my picks, is off to a slower start this year after outperforming the broader TSX index for 5 consecutive quarters. So we actually saw the REIT index down 0.4% versus a positive 3.8 for the TSX in the quarter. In particular, we've seen selling pressure on some of the higher growth names that worked really well last year and ended the year at relatively elevated valuations. Obviously, a more hawkish Bank of Canada and Fed and a sharp spike in long-term bond yields are leading to some concerns around the potential for cap rate expansion and therefore pressure on overall real estate valuations. On top of that, inflationary pressure is beginning to show up in operating costs, while at the same time, we're seeing regulatory shifts reduce pricing power, particularly in the Canadian residential space. So with that as a backdrop, in the REIT space, we favor names that have the ability to organically grow revenue faster than expenses, offset potential cap rate expansion with outsized NOI growth, and that have debt profiles that are well equipped to weather any increases in longer term bond yields. Flagship Communities REIT. This is a name that is new to our coverage as well as new to our top pick portfolio this quarter. The REIT owns a portfolio of manufactured housing communities, so essentially trailer parks, across 7 states in the central and Midwest US. It may not be the most attractive property, but it is a very attractive industry. The trailer park business, it's highly defensive. It has an exceptional track record of delivering steady and positive growth across all economic conditions. The flagships offering and the trailer park business as a whole obviously enjoys a significant affordability advantage relative to alternative accommodation. Monthly occupancy costs are generally 30% cheaper than apartment rentals and 40% cheaper than home ownership. And at the end of your ownership period, you end up owning the equity in your home. So highly defensive in that respect. Further, affordability has only improved along with the REIT's pricing power as wage growth has accelerated through 21, reaching 30+ year highs. Most importantly, wage growth is strongest at the lowest income quartiles, and that's where the REIT would draw its typical tenant. On top of the REIT's ability to increase rent consistently, portfolio occupancy sits at 83%. Management has a track record of growing that occupancy by 100 to 200 basis points annually. We expect they'll continue this till it stabilizes closer to 95%. And we also see a substantial external growth opportunity through accretive acquisitions. The industry is highly fragmented. The 50 largest institutional owners own less than 20% of the market, and management has a great track record of growing. Finally, the valuation is very compelling. The REIT trades at a 20% NAV discount and 17 times forward FFO. The peers trade at 26 times forward FFO, so nearly a 10 times multiple spread. And in terms of closing that valuation gap, management's got a 25-year track record as a private company, but this REIT has only been public since late 2020. We think as their track record in the public market grows and they get more eyes on the stock, the NAV discount will narrow, and over time they will continue to grow NAV. And with that, I'll pass it on to Ryan.
Great. So wait for the next slide to pop up here. And two returning names for myself on the top picks list. They've both been on for quite a while. First, Echelon Resources. And recall, this is a gold exploration development story in Namibia. So why do we like it? Well, number one, Namibia. You don't hear the negative headlines out of Namibia that you do some of the other African nations. They call it Africa Light, Africa designed by the Germans. So a nice spot to be in. A large and growing gold resource in a mining neighborhood in Namibia. Currently about 2 million ounces. Not a sexy, high-grade, flashy story. Just kind of a, methodically moving forward, de-risking 2 million ounces at about a gram. Nice big off-the-shelf, open, pittable type deposit. And that resource is expected to grow in the near term. We get an updated resource estimate during this quarter, probably towards the end of Q2. They've done some infill and extension drilling since the first resource was out last year, both extending existing deposits, both up and down dip. So, adding right in the immediate footprint, but also adding in new zones. We have the Twin Hills Central and the Cloud deposit as the anchor there. New zone about 3 or 4 kilometers away, Twin Hills West, has added some material as well, actually some higher grade material. So all that will go into the updated resource estimate, and then that forms the basis for a pre-feasibility study. So we've had a PEA, we're de-risking it more with the pre-feasibility study, more engineering, more real-world cost numbers, and that will be out subsequent to the resource estimate. And that will actually look at, obviously, a bigger resource that's coming. We'll look at project optimizations from the PEA level to more confidence level, and then a higher throughput rate is actually planned as well. And so the aim there is to get the eventual production up to about 150,000 ounces a year from the 100,000 ounces a year that PEA contemplated, and that just opens it up to a broader acquisition potential acquirers out there. And the obvious one, B2Gold, which is about 100 kilometers to the north at the Otjikoto mine. That's been one of their better mines. Well, they bought that mine off the team that founded Osino back when it was Oryx. So we'll look for that. And then longer term, and this won't be in the PFS, but Osino actually acquiring a project, a smaller project near their project from B2, the Undundu project. That's supposed to close in June. And that could potentially be in trucking distance. There's work to be done there. But, you know, if you can incorporate that, that gets you closer, you know, 180 to 200,000 ounces a year. So, opening up to even a broader takeout market there. So just a methodical story, like I said, not sexy, not high grade, not steering results, just consistent mineralization, open pittable, off the shelf processing, and moving it forward into a nice stable market, nice 1900 floor that we seem to be about 1950. It definitely works at those numbers. So that's really it on Osino in a nutshell. So we'll move on to the next pick, which again is a returning name, and it's Pan Global Resources. So this is an emerging copper tin resource in Spain in the Iberian Pyrite Belt. And if you want a VMS deposit, of which this is, that's where you go. They've been mining here literally since the Roman era, and you know, just the type deposits are here, and they've got one of them. They've got one actually sandwiched in between numerous mines on either side along trend. And you know, the main thing we like here are the commodities, copper, tin, and there are other metals in it as well, but those are the main two. And amid a backdrop of electrifying everything, try to do that without copper. So that's the main commodity. And then if you're electrifying it, well, you're probably throwing a handful of microchips in there to make it smart as well. And, you know, you need tin solder to produce those. So the two main commodities are definitely hot commodities here. And you know, the other thing with tin in these type of systems, when you have tin in these VMS deposits, it usually is a signal of a large system. So they've been focusing on the La Romana target. They've been drilling that one until recently exclusively. And you know, so an emerging resource there, pretty good clarity on that becoming a real deposit. And that's one of 12 targets. They've actually just started into the second target, La Llorosa, which is another gravity anomaly. That's how these things are found. They stepped out from a historic hole back in the 80s, basically duplicated that. So proof of concept. It's not just a gravity anomaly. There's something there. So follow up, they've got 3 holes already sunk nearby to follow up on that. And then once they get that back, we'll do some more geophysics, hone in on some of the other targets better, and then really get after it on both sides of the property here with 40 to 60 planned at 20,000 meters of drilling. So very pivotal year. They've been waiting to get onto that La Llorosa target and the other ones on that El Andaluz side of the project. And they're going to be very aggressive drilling there this year. Should be, you know, really tell us what those other targets are and where this story is going. So that's quickly Pan Global. And I'll pass it off now to Gabriel, my partner in crime.
Okay, thanks, Ryan, and hi, everyone. So my topic for Q2 continues to be SilverX Mining, ticker AGX on the TSX Venture. I have a speculative buy rating and a $1 price target, and that's based on the company's production, financial, and resource targets, catalysts for Q2 and Q3. Performance in Q1 was disappointing because of delays in expanding production at its Nueva Recuperada project in Peru and generating cash to repay a convertible debenture. The stock returned a negative 22% compared to the global X Silver Miners ETF of just 0.2%. If you saw the internal use only comment that I sent around this morning, the company just today announced that it has completed the plant expansions to 720 tons per day, and it has also been getting better than expected production grades to the plant, and that includes higher than expected gold values. So I'm confident that they're on track to generating meaningful cash flow and are going to be better placed to renegotiate or refinance that $4 million convertible debt that they owe to one of their larger shareholders. And that convertible debenture has been, in my view, the biggest overhang on the stock. But as I said, it's on track to being renegotiated or repaid, so that will be lifted soon. Besides that, the company is also moving forward with drilling on the property to prove up parts of its 7.2 million ton inferred resource into the MNI category which should provide greater investor confidence in the resource and a strong basis for an upcoming PEA sometime mid-year. Additional exploration drilling is ongoing on what I think is a very highly prospective property, which I visited in October of last year. And it's also a mining-friendly district in Peru. Current production levels of 720 tons per day are just enough to produce about 1.8 million ounces per year of silver equivalent production. Two things to note from that are that number one, other non-producing companies are trading at multiples that are much higher than Silver X's. And number two, the company has initiated permitting for an expansion to over 2,000 tons per day for sometime in 2024 or 25. At that point, the company will begin looking a lot more like a Fortuna Silver when it started with its Cayoma mine in the late 2000s. And I do think Nueva Recuperada has the potential to be a company builder, just like Fortuna had with Cayoma. Finally, just a word on valuation. This is a producing company that is currently trading around 30 cents per ounce of silver equivalent resource. Now, this compares to the junior silver producer developers that aren't anywhere near production, that on average are trading at nearly $1 per silver equivalent resource. Production is still currently at pre-commercial levels, pending consistent production at their expanded run rate. But I think that once they've declared commercial production in early Q3 and started focusing on their next leg of company growth, the company will start showing up on more investors' screens and should garner an increased multiple. So this is still a story that is in its early innings, but I think it's well positioned to deliver future growth. And with that, I will hand it over to Michael Mueller.
Thanks, Gabriel. So this quarter, reinstating E3 Metals as our top pick in the renewable space. We do have a spec buy rating and $5 price target on the company. Just a quick refresher on the company. This is a junior lithium brine developer, very large resource base in Alberta. Company's also developing a direct lithium extraction technology in-house. No one else is doing this. Most companies either own the resource and licensing the technology or vice versa. So with E3 keeping its ownership at 100%, it hasn't sold the farm yet. This will open many more doors as it continues to advance its project. We look to 2022 as being a pivotal year for the company. We see a number of meaningful de-risking catalysts on the horizon. The stock had underperformed its peers in the junior developer space in the second half of last year. It's tracked the lithium index in the first quarter. You see the potential for outperformance just with news flow increasing this year and causing that to help catch up the difference. I would again point to its the sizable resource base. This is a key feature in the long run, offers a lot of running room beyond the first phase of development outlined in their PEA. E3 also trades at a large discount to the group on a resource basis at about $20 a ton, with the group roughly tenfold this. This discount, in my view, it's in part from the technology and the risk associated with that as they're working to scale that up. That is one of the de-risking events expected this year. Company just announced just earlier this week, it's sourcing manufacturers for its sorbent. That's a key component of this as it moves to the commercial scale. And that will also be part of a planned field-based prototype expected late this year. And another, just quickly, key point that's unique to E3, it's its operating jurisdiction. They're entirely in Alberta. They have applied and received some grant support. Would expect a larger magnitude of that to go towards a field-based pilot later this year. Additionally, on Alberta, I mean, the AER, the regulatory body that oversees oil and gas, a bill was just passed that will give them oversight in lithium. And what that means is as they move to permitting and going to commercial production, the turnaround is fairly quick, as it would be in effect a well license or well licenses and a facility license. So that could possibly take about 6 to 8 weeks to get the project permitted. So sum it up, this is a name that's underperformed a hot lithium sector, and it is on the cusp of some major developments that'll bring more attention to the name and alleviate some of the perceived risk on the project. So I'll leave it there. I'll pass it back to Rob for questions and to wrap this up.
And thank you, Mike. So with that, we will welcome any questions. You can post your questions. You can email Amber or myself questions, and we would be very happy to post them to the group. So with that, perhaps Amber, do you want to lead in with the first question?
Yeah, I just want to recognize time, so we'll do like rapid fire, I guess, Q&A, and maybe we could start with Mike Wheeler, because we were just like presenting. Well, can you speak to the de-risking of the tech, and like what should we watch out for, and how soon is that tech de-risked?
Yeah, it's a good question. Really, they've checked all the boxes in the lab. Where their tech's at, it's basically smaller scale lab prototype. Recovery rates have all been meeting expectations. So that's a positive. As I mentioned, they're working on sourcing a manufacturer for their sorbent that would lead into the field-based prototype. So that's more of a second half Q4 kind of timing there, but that would be a pretty material de-risking event, as they could prove they can do this at scale.
Fantastic. Maybe I'll jump in for Ryan with another one. Like we're seeing a lot of projects have a lot of CapEx creep, and I'm just wondering on Osino's Twin Hills, is there that potential?
Yeah, I mean, there certainly is. I think, if there is, it would be relatively modest. Namibia is a lower cost environment. We're not talking about a massive operation here either, although it will be scaled up in the PFS, but I don't expect, a 50 or 75% blowout, anything like that. And some of the increase will be down to that scope project increasing, and along with it bringing, ounces forward, so benefiting the MPV, but not overly concerned with a massive CapEx blowout that's going to also blow out the share structure. So, but certainly it's not immune to that either. But I think whatever it does experience would be relatively modest.
Okay. Maybe I'll jump in with one last one and pass it on to you, Rob. To Gabriel, I mean, I hear you on the morning calls that we have on the institutional side speak about the large valuation disconnect for SilverX. And I'm wondering, like what's the catalyst that sort of alleviates that disconnect?
Sure. So I think the principal catalyst is the convertible debenture. It's $4 million owed to a shareholder of the company, and because of the delays in production, the company probably hasn't generated the kind of cash that it needed to comfortably repay that debenture. So I really view that to being the biggest holdback to valuation, possibly reaching commercial production levels, which is really just producing, I think, 70% over your stated capacity for 90 consecutive days, which would be expected in Q2. That could also be a meaningful sort of de-risking of the company. And having said that, I mean, that valuation disconnect with companies that aren't even in production or anywhere near production is I think just too hard to ignore. So I think eventually once the company does overcome those two main catalysts, the convertible debenture and reaching commercial production, I think it does give the market greater confidence in the story. And so I think those two catalysts are really going to do it for the company and to lift that valuation.
I'll just pause here for a second or two if anybody wants to jump in with questions.
I may just jump in with one we'll turn to Ottawa. And David, we've seen really impressive rent increases from BSR. To what extent is that just like a post-COVID recovery in rents and therefore not sustainable?
Yeah, thanks, Rob. Frankly, I mean, the Sunbelt markets actually held up very well in 2020 through COVID. So there wasn't a rebound that you saw in some of the coastal markets. And a big driver of growth in 21 has been interstate migration. So from more expensive Californian markets to BSR's Texas markets. So we don't see issues of affordability yet in their portfolio. Rents are generally 20 to 25% of median income. In coastal markets, this figure is as high as 30, 40%, even higher. And on top of that, we mentioned that US wage growth is at highs not seen since 1990. And this should continue to support solid rent growth going forward. Last year was 17%. I'm not calling for that again, but you still have to mark, all of the leases from the first half of last year still need to be marked to market. On top of that, I'd expect mid-single digit rent growth this year. So you've definitely got a good runway of another 12 to 18 months of rent growth.
Okay, thank you. My question for Andrew, like as one who's been facing headwinds, as you have, what do you see turning sentiment around? Is it new states coming online? Is it M&A where there has been some disappointment?
I think what we haven't seen substantially in the last 2 years, and that really does turn around sentiment, is these new states coming online with adult use approvals. We have seen 3 markets in particular be very strong drivers behind the growth rates of US cannabis over the last 2 years. Those were Illinois, Florida, and Pennsylvania. In Florida and Pennsylvania, we saw new dried flower approvals. In Illinois, that was a situation where the market went adult use. So you really do need to see an expanding either medical program or a new adult use market to see the exceptional pace of growth that we've seen in the past few years. And that is why we are so excited to see New Jersey, population 8 million people, should go from a market size of about 200 million to about 2 billion over the next 3 to 4 years. So we were so excited to see New Jersey come online this quarter, Connecticut come online later this year, and hopefully some new approvals to continue to fill that pipeline with new adult use market opportunities. So we really think that's what improves sentiment and gives the companies the best chance for upside and exceeding the consensus forecasts.
Thank you. Let me ask just one more question. I'm going to turn to Amer on this one. With Echelon, and you said it's a relatively larger name, has 3 different arms to it. Do you see the company, taking specific moves to crystallize value, or how do you see it getting this value more in line with this growth?
Yeah, I mean, they actually have like 4 divisions. I only spoke to 3 because the 3 largest ones, but the quick answer is management says no historically. They like having 4 divisions. They love the diversification. And the issue they had historically is that these divisions weren't large enough. But if you sort of fast forward to maybe in a couple of years, some of these divisions are getting like much larger and much more attractive. They could be like floated into the market or sold to maybe a strategic player. So quick answer is no for now, but stay tuned. And this is what we love about this company. There's optionality for them to create value. Maybe one for Stefan. I mean, I asked Ryan about inflation. I could have asked anybody about inflation. To you, I'll ask you about supply chain issues potentially affecting Quipt.
I think supply chain issues are affecting everybody. Everything I've heard, from like any sector, it's really affecting markets globally. From Quid's perspective, they're already being hit to some degree by a recall in CPAP machines with one of the big producers, which is Philips. Luckily, they are their primary supplier is ResMed, which is the other big player. So they've actually done almost better than almost anybody else in the space because of their relationship there. But still, it's a headwind for the company. So what's happening in that instance is that they're gaining a big backlog of patients because the patients don't go away. They still have sleep apnea. So it's a bit of a front end headwind on revenue in the first half of the year, but will likely get reversed as more supply comes into the market. The other thing broadly I would say is, the company, part of the story as it scaled through M&A was that its EBITDA margin would be expanding, say, from about 20% to sort of 25% over the next couple of years. With they continue to scale the top line, and what I've sort of expecting in this more challenging environment is that you're not going to see the same margin expansion you would normally see, but overall they're doing a good job managing their EBITDA margin despite the challenges.
And I think we're only missing Rob. I've got 2 questions.
I was just going to take it to an end right now, Amber.
So the first on Quisitive, like Quisitive are only linked to Microsoft and no other players. Like, what's the downside there?
Sure, and I think
it's and maybe the upside as well.
Yeah, and it's very fair. If you're looking for IT services and you go to Quisitive, there's one solution. It's a Microsoft solution. So I wouldn't necessarily go to them, preferring the multi-cloud environment supported by Alithia for one, Converge for another. And frankly, years ago, my preference for Converge ahead of Quisitive reflected that. What has changed? They've gained scale. They made the acquisition of Catapult, adding 50 million of revenues in the fall. That's a very smart acquisition, brought them cybersecurity capabilities. So I'm not as concerned within the IT services. I also know that Microsoft has brought them over 400 prospective clients. I know that Microsoft brings them acquisition targets because Microsoft knows that it's going to them. It's not going to be split up. So whereas it had held me back, less so. And I think that the broader Microsoft relationship is the huge asset there. And I really look for what Microsoft does with LedgerPay. There was a point where they were developing the LedgerPay platform. They had Microsoft engineers side by side, shoulder by shoulder with Quisitive engineers to get it done, expand capabilities. So IT services, there's a little bit of a consideration that way, but I think they can address it, and the scale addresses it. The broader is a huge positive, and we really look for that to do some interesting things with LedgerPay. Then
my last one is on Converge and their backlog being potentially inflated.
Yeah, we've heard that one, and it all gets down to the definition. A backlog is a committed order for delivery. So it is not a case of people, asking for 5 servers when they want 3 just to get to the top of the queue, because if they put in an order commitment for 5, they're going to get 5. So, we always respond to that question saying it's a legitimate, discrete revenue line waiting for delivery. And frankly, we urge people or highlight to people that there's going to be a quarter where this 400 million backlog is flushed. And then you're going to see probably $150, $200 million boost to that revenue quarter. Don't know when it's going to happen, but we're waiting for the proverbial flush.
Fantastic.
If there are follow-up questions, please reach out directly, email, call, and we would be happy to respond.
Thanks, everybody.
Thanks, everybody.
Thank you, everyone. you.